Hey, what's up, everybody? Let's do a big tobacco stock analysis. So we're going to look at Altria Group, British American Tobacco, Phillip Morris, and Imperial Brands. We're going to compare their dividend yields, compare their payout ratios, look at some of the risks they face, some of the diversification going on with some of them. We're going to look at their expected growth or, decline over the next couple of years. And ultimately, I'm going to give you guys my thoughts on which ones are the better values right now. Alright guys, so before we get into the numbers, here's just my thoughts on why you might consider investing in big tobacco stocks and some reasons why you may not consider it. So the reasons to invest, first of all, they pay extremely high dividends. The yields we're going to be seeing are going to be much higher than other stocks you look at. The other reason I would recommend it is because their products are literally addictive. It's the perfect product. It's extremely cheap to make. They're not growing much or at all, so they're not making any reinvestments. Management is not trying to get too creative. So it's a really simple business. Even an idiot could run it, and those are the kind of businesses you want to invest in. However, there are some reasons why you would not want to invest in big tobacco stocks. Number one reason for a lot of people, they view it as being immoral. They don't want to profit from death as they see it. These companies make products that kill people. So, if that's the case, that's the case. And, I would just not invest. Another reason people don't want to invest is because, let's face it, these companies are, at the best, in a maturity phase. A lot of people would say they're in the declining phase, so it's not a very exciting investment in that regard. So British American Tobacco here, trading at about 37 bucks a share, giving it a price to earnings ratio of 9.66. The dividend yield is just about 8%. And they are an $84 billion company. Let's look at Altria Group next. Altria Group has had a nice run up in the stock price over the past month, going up 12%. It's now trading at about $48. It has a price to earnings ratio of 10.6, and they're yielding just about 7%. They are one of the larger companies with a market cap of $90 billion. Phillip Morris International trading at 87.72. They are trading at about 14.7 times earnings, so one of the richer valuations in the industry, and they're yielding 5.47%. They are the biggest. This is a $136 billion company. Finally, we have Imperial Brands, certainly one of the smaller companies here. Market cap is just about $18 billion, but they have the largest yield. They're yielding 9.37%, trading at about 9.5 times next period's earnings. Let's compare a few balance sheet ratios for these companies. The liabilities-to-assets ratio captures the degree of leverage at a company. These companies are pretty highly leveraged, but there are significant differences. One thing I really hate to see here at Phillip Morris is extremely high leverage there, over 100%. They have more liabilities than they have assets. In other words, they have negative book value. Altria Group is also doing pretty poorly here at 93.7%. The real winner here is British American Tobacco with a fairly low leverage ratio. You see, Imperial Brands also has a fair degree of leverage with 82.9%. As far as liquidity concerns, the current ratio for all companies is fairly tight. It's not that different. It's close to 0.8. The only outlier here is Phillip Morris with a current ratio of 1.1. Meaning their current assets are 1.1 times their current liabilities, making them a little bit safer on that front. But that really doesn't overcome the problem with their liabilities to assets ratio. So I see Phillip Morris as the riskiest from this standpoint. Other data we may want to consider includes dividend data and growth data. So let's look at dividend data first here. I have the yields. As you can see, Imperial Brands has the best yield, but really all companies have a great yield here. The payout ratio is very important though. That tells you, what ability do they have to continue raising the dividend. When you look at Imperial Brands, 90% payout ratio, they really don't have much room to raise a dividend unless they're going to experience some growth in earnings. So in this industry, you're not going to see a lot of growth. That tells me that their high yield is high for a reason. They're not going to be able to increase a dividend by very much. For Altria Group and for Phillip Morris, the payout ratio is fairly high, but not outrageous for the industry. They can still grow there. For British American Tobacco, it's actually abnormally low here at 66%. I really like to see that, and I think that gives BTI the edge here. When we look at the growth data and earnings, we have two data points. We have past 5 years dividend growth and next 3 to 5 years of earnings per share growth expected. We start to get a more clear picture here of why Phillip Morris is priced so richly. They're expected to grow their earnings per share at about 10% over the next 3 to 5 years per year. Very impressive. That has to do with Phillip Morris having international operations in markets where cigarette use is actually still growing. Compare that to the other companies. For Imperial Brands, they don't have analysts following, so we don't have an estimate. But, for Altria Group in the US here, pretty poor growth there, 3.83%. Probably just coming from price increases, not really any growth from, additional users. British American Tobacco, 5.73, in between there. And we can look at the past 5-year growth to get a second data point to help us corroborate the story here. And for that, it's kind of consistent here with the high yield for Imperial Brands. They've experienced declines in their dividend over the past 5 years. Altria Group has done the best, and so that is another data point to consider. Okay guys, so at this point in the video, I'm going to try and come up with a fair value for all 4 of these tobacco stocks. To do that, I'm going to use the dividend discount model. The dividend discount model says the value of a stock is equal to the present value of all the dividends you're going to receive from owning that stock. It's a model that usually doesn't work well to value companies because they often keep a lot of their profits in the company. They don't really pay out as dividends everything they make. But with cigarette companies, you're going to find the dividend discount model actually works pretty well. So let's use this model and let's see which stocks are better value. Alright guys, so we look at British American Tobacco. If we use an 8% discount rate or required rate of return, which I think is fair, they're pretty low leverage company. And we want to grow dividends. Let's say they grow them at 0% in perpetuity. The stock would be worth about $37.25, making it about fairly valued. But again, I think given the analyst estimates and you look at the payout ratio right now, even if they don't grow earnings, they can certainly afford to raise that dividend. I think that's a bit pessimistic. If we plug in, say, just a 1% growth rate, the stock instantly becomes, pretty undervalued at $37.46 compared to a fair value of about $42.50 here. So British American Tobacco looks like a good deal. And that's even still, I think, being a little conservative. I think we could see 1.5% growth in dividends. Next up, we have Altria Group. Again, 8% discount rate, growing at about 1.5% there. The company would be worth about $52.92, making it undervalued. The thing about Altria Group is they do have other things going for them, with their stake in Juul Labs and also their stake in Kronos Group. We have potential marijuana legalization going on. So for them, I'm going to incorporate a 1.5% growth rate. We can look at what happens if I drop it to 0. The most pessimistic case, the stock is slightly overvalued at that point. But again, I think, a little growth is probably expected. I'm going to go with 1.5. Next up is Imperial Brands. If I use an 8% discount rate and I assume no growth in that dividend, it's undervalued. It's undervalued pretty significantly, trading at about $19.63 with a fair value of about $23 there. Pretty significant undervaluation. So finally, we have Phillip Morris. Now, I'm going to start off with an 8% discount rate, at least a 1.5% growth rate. We probably could even go with 2%, maybe even more. Maybe 2.5 would be fair here. And, it looks to be about fairly valued if we plug those values in. Now, 8% return, I think, unfortunately for Phillip Morris, with their very high debt ratio, I would be requiring probably a 10% return or even more. So even if I give them better growth rates, I can kick this up to 3.5% or so. You're still looking at a stock that is overvalued in my view here. One last factor to consider is insider trading activity. For Altria Group here, we have some insider buys in the past 3 months. When we look at the number of shares involved here, it is quite a strong signal to see that insiders are buying their stock significantly more than they're selling it. Phillip Morris, you've also got more insiders buying compared to selling. Again, here for Phillip Morris, the number of shares involved is much more than the number of shares sold. Also a very positive signal. Unfortunately, we don't have insider trading data on the other two companies. Alright guys, here are my final thoughts on the big tobacco stocks. Number 1, you've got Imperial Brands. I gotta say no. I think it looks undervalued from the intrinsic valuation model, but that model is assuming they can maintain their dividend at 0% growth. I'm not even sure they can do that. And we don't have any analysts following them, so we have a lot of information risk there. Their payout ratio is 90%. So I'm not really sure they can raise it or even maintain it. I don't like it. I'm going to pass. Next up, you got Phillip Morris. Phillip Morris has the best growth, but they also have the highest valuation by far, trading at about 14 or 15 times earnings. And they have the highest leverage ratio. So to me, that doesn't make it worth it. I'm not going to buy Phillip Morris. Their leverage ratio of about 125%, not sustainable long term. They're going to have to pay that debt down. And as they do that, that's going to cut into the dividends. So I really don't like Phillip Morris going forward. That leaves us Altria Group and British American Tobacco. So Altria Group, a month ago, I would have said definitely buy. The stock price has really run up. I would wait for a better entry point. I do like Altria Group. They got their stake in Juul Labs. They got a piece of Kronos Group with the marijuana. They own about a 10% stake in Anheuser-Busch. So they have a little diversification going on. It's not a bad investment, but I would just try and wait for a better price. That leaves British American Tobacco. That was my top pick last fall. It ends up still being my top pick. The price has increased. It's not going to be as good of a deal as it was last fall. But, it's still undervalued. Look at the leverage ratio. Look at the payout ratio compared to the other stocks. British American Tobacco looks a lot better. Their growth prospects are not bad, considering half their sales come from the international markets, which are not declining at the rate the U.S. market is. So overall, I like British American Tobacco. For me, that's still my top pick. Let me know what you guys think in the comments below. Hope you enjoyed the video. Thank you for watching.